When you look at the price of a stock, what you're actually witnessing is the most recent price at which somebody has sold it. This means that if you sell an Apple share for $1, the share price of Apple for everyone worldwide would also be $1, for a split second at least. The stock market operates like a continuous digital auction, where shares are bought and sold electronically every second. When there's a surge in demand for a company's shares, the price rises. Conversely, if more people are selling than buying, the price declines. All share prices naturally gravitate towards where the majority of investors currently believe it should be, and the higher the trading volume, the faster this adjustment occurs. But companies aren't always valued on the money they're making now. Investors love to look ahead to the future. Even the smallest piece of news today can shape investors' perceptions of a company's worth a decade from now. It's like predicting a champion in the making. Positive news, like a company announcing an exciting new product, can change the amount that investors believe the company will be worth in the future. That belief leads them to pay more for its shares now. On the flip side, if bad news strikes, like a company's CEO leaving unexpectedly, investors might think the company's future isn't so bright, causing share prices to drop. When you purchase a stock, it's essential to always have your own assessment of what you believe that company is truly worth. In the end, a share price is merely a reflection of what other people are currently willing to pay and accept. Your personal evaluation should guide your decisions. But don't take it from me, I'm just some dude. Take it from the investing wizard Warren Buffett.
What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well